What's going on, traders? Welcome to the Market Primer for October 10th, 2022. We're starting off with the S&P 500. I came into last week because we had aggressively sold off, finished near the lows, and I thought, okay, we're going to see a gap down on Monday, maybe some follow-through on Tuesday, and then we get maybe a reversal from that. Instead, what we got was a very strong move on Monday, and what happened is that some key swing anchored VWAPs came into play. Let me just do the yellow right here. And more inventory showed up right there. And then we just completely rolled over and have effectively gone back to square one in this market. One thing I want to condition you all who are watching for is that you need to come into this almost as agnostic as possible, because this could be, for example, the start of some kind of a double bottom pattern, and then we roll up. It could be some kind of a failed move, and then we see another gap up, and then we run up to about 386 right here. It could be an actual follow through, but it truncates just to the downside a little bit, and then maybe some kind of a bottom. It could completely fall apart too. So there's just a lot that's contingent on how the market responds into key levels, and that's the main thing that we have to watch out for. So when the market runs up, like it did on Monday, and the auction fails on Tuesday, and then the auction fails again on Wednesday, I think I got that wrong. Monday, Tuesday, Wednesday, Thursday, and then a complete rollover. That tells us that into that move higher, there were aggressive initiative sellers willing to liquidate their positions into that. Until that behavior changes, you have to assume that this market's going to stay weak. It's that simple. So if we come back in and start to retest some of these levels, maybe fill gaps and prices are accepted, and we see failed auctions to the downside, then maybe you can get something for a little bit more of a bullish case. So I currently have the volume profile on for a very specific range, and it goes back to about right here, because this is the range that I'm keying off of. One of the risks that we have in this market right now is that relative to the volume we saw here and here and here, underneath there's not a lot. So if there aren't prior buyers willing to buy back at that, there's always the risk of a bit more of a rollover. Nevertheless, you can see how strong these levels are acting. I haven't changed any of these recently. The LVN right here was basically the low on Friday, and then we saw a bounce. The swing anchored VWAP, as well as this low volume node right here, acted as a pivot level, as well as this one. So all these levels are still working. I don't really see a whole lot of incentive to change them right now. These three thin lines right here, you can kind of view them as a single set if you wanted. But basically they're just what I would consider pit stops. I don't think they're massive levels to work from, but just in the range that the market's developed since that pretty aggressive sell-off on Sep 21. The market's been coming into these levels pretty cleanly, right? Pit stop here, run to this side, completely roll over, and then we come back in, we retest this level, we see a gap down, a potential retest, and then going lower. So don't necessarily view them as like, oh, this level has to hold, otherwise the apocalypse is coming, or this level needs to break out for us to have some kind of a bull trend. It's just where the liquidity reversals have tended to happen over the past month, as well as when we saw this trading range prior. So the levels really haven't changed. To the downside, we do have Friday's low and maybe just a little bit above it. I want you to see this price interaction here, here, and here. If we view that as its own range, then we have the kind of scenario where support holds, support holds, support holds, huge, nasty move lower with a stop run. And then once it retraces, there might be something right there, but that just remains to be seen. So just key off of these lows right here from Sep 27 and Sep 28 and 29, right around 361, and that might be something. Below that, we do have 358, 356 right here. Underneath that is going to be 352.72, and that's going to be the next big level. And then if we really wanted to, the big level I'm watching, if we really wanted to move to the downside, is about another 12% lower, and that's about 338. But again, we just don't know the kind of speed it's going to take if we are to get there. It could see something where we could do this and then do this and just march lower, or it goes straight down, or it just doesn't happen at all. Okay. You just got to use these levels as reference points. And then even if you're not trading against those levels, the question to ask is, how is the market responding against them? Because that's going to give you some clues. To the upside, we have 368 to 368 and 3/4. I'm actually going to take the swing anchor VWAP off because we just gapped through it. Above that, we've got 370 to about 370.89, maybe 371 right here. Did I get all of that right? Yeah. And then we've got a gap fill coming in at about 372. And then above that, maybe 376. So, if you want to put this in context and just say, okay, what kind of volatility can we expect? The range that we saw from Monday's open, well, let's just say Friday's close to this open, is the week's range was about 23 points. So that's 230 points in the S&P futures, okay? So just based off of this level right here, where's 23 points from here? That's going to be 363 plus 23. That's going to be 386, which is right here. If we were to see the same kind of volatility, and then to the downside, unfortunately, because I try and do this live, I've already forgotten the number, but we can do a very clever thing and just say, here's the high to low, and then we're just going to take it onto this level right here. All right, and that if we were to see the same kind of movement and volatility straight down, then it would be 339, 340. All right, and that would be a straight down kind of move. Odds are if we were to get a strong move down to 345, 347, we would probably see a pretty aggressive bounce into that. Very similar kind of mechanics in the NASDAQ. Came into Friday's low. There's a decent level right there. We see a bit of a gap up and a run on Monday, a bigger gap up on Tuesday. Collect all of these swing anchored VWAPs. Oh, one more thing, just because I'm thinking about it. If you take a look at the S&P 500 futures, you see this level right here. That was the overnight low from Sunday. And that level corresponds with the swing anchored VWAP from the 2018 lows. And you say, oh, that's kind of a stretch, but look at how the market has interacted with it here and here and here, against it to the other side, retest that level. So this is a pretty big, longer term level. And, we can break underneath it a little bit. Maybe if we really roll over and retest it as it rolls over like that, that's a proper acceleration of the bear market. But this is just a nice level to keep an eye on. All right, back to the NASDAQ. Same levels still apply right here. Let's just go ahead and zoom into a 30-minute chart so we can see it. We'll take off these moving averages so we can just clean this chart up. There we go. And we'll expand that. Okay. So first level is going to be Friday's low, maybe just a little bit underneath that at 265 to 267. I know that's a wide range, but it's a very volatile market. To the downside, we've got 262 2/3 down to 261 half. And then the big level I'm watching is 256.14. I know that's a ways away. But again, if you just look at the week's range from Friday's low to that high, if we were to get that kind of move off of Friday, then yeah, we're going to start collecting that level. All right. So that you say, oh, that's a stretch. Well, that's just kind of normal with the volatility that we've been seeing. Okay. And that's, again, I'm not trying to lean bearish. I'm just trying to make sure that, at least for me, I'm not trying to buy the dip way too early into some kind of a crush. To the upside, we've got a very, this level right here has interacted here and here and here and here and here and here. So this is a nice little pit stop level. Above that, we have a pretty decent gap fill all the way back up 279 2/3. That's going to align with this swing anchored VWAP from this gap right here. And you can see we poked above it for about an hour and then completely rolled over back on SEP 21. Very similar kind of idea where we just nosed over it for, about an hour and then it rolled over again. So this seems to be a pretty important level. If you want to be bullish on the market, you probably want to see this come up. One other thing to keep in mind right here is that volume weighted average prices use volume. So one of the things that can help reverse the trend is if a lot of volume really starts to come into the market. And that tends to only happen on capitulative moves or some kind of a catalyst, potentially due to a Fed event, that will bring in a ton of volume. And if we, for example, just build out a ton of volume right here, all these swing AVWAPs are going to start really rolling over, and then you have the potential for reversals. Okay. Next up, IWM. Key off of this, because if you notice, we're nowhere near Friday's low. So there is a slight outperformance in the Russell. I think that there is something here, and the reasonable explanation is that the biggest risk in the market are the generals. So very, very large cap stocks like Apple and Microsoft, where there's just a lot of holdouts in this market right now. And that's where the liquidity break could happen. And there's just a lot of names in the Russell that are doing a little bit better. They're not getting truck stick to the downside. They're not necessarily going in some massive bull market, but there is relative outperformance in small caps right now. So that's something you have to keep in mind. We do have a million swing anchored VWAPs all coming into play right here. So that's just going to be a big area. That's just going to be an issue. If you wanted to play options, if we were to spike into that, you'd probably get away with selling some calls. But overall, see this price interaction right here. That I think is a pretty big level. And we just hit it on Friday. I want to see how it trades into Sunday's open on the Russell futures as well as Monday to see if that level is going to hold. Let's zoom in. We're going to go through a 30-minute chart again. The clear lows from this range to the downside at 163 third. And then further down, we've got 161 and a third right here, all the way down to 159.80. I know that's a very large range, so you just got to work with it from in there. And then the big level I'm watching all the way down here is at 154.33. There's a very real possibility right here where the large caps could take a hit and go grab some other levels. And then the Russell just trades here, maybe sees a dip to run some stops and then rally back up. So that could be one of those where it's technically a bullish scenario, but you have to have some downside price action for it to develop. To the upside, I do have this level and this level and this level just loosely marked on this chart to see if we can get back above it. But right now, that's just up in the air. So that's just a nice reference point at 170 half. Then we've got a gap fill at 173 half up to 175. And then we come into all those major swing AVWAPs against this range right here, which is going to be a bit of an issue. So the bullish case is almost range bound for this. Right? We rally into this, we find some sellers. What you want to see instead is sideways price acceptance or, range breakdown that fails. And that kind of failed auction, you can see the failed auction to the downside over here. You want to see it on the other way. And that was almost a possibility on Friday where we had the lows put in. And maybe if we knifed in and then we started to run, that would have been a much better scenario for the bullish idea, but we didn't. And so you have to be at best neutral and just make sure that you're managing your risk properly here. One thing to take a look at also is the VIX. The VIX continues to stay around 30. This, 34 to 35 has been a big level that I've used this entire year. So that's just something to keep an eye on. And then watch how the VIVIX trades, VVIX, and this is the demand for VIX options. It's been much more suppressed, meaning that you just don't have a lot of hedgers going out and buying a bunch of VIX options right now. And I think that's just, you say, a lot of folks would say that it signals complacency, but that's not how the options market works. This continued to see lower highs and lower lows all throughout, even into the June CPI crush, there was just a non-confirmation right there. So if this continues to have non-confirmation, then that's going to be a good thing. And one other one just to keep a close eye on is the MOVE Index, MOVE. This is basically the VIX for bonds, and it's continuing to trade near its highs. And that's why we're not trading the stock market right now. We're trading the bond market. And this has to do with the Fed and broken rates and a very strong dollar against a lot of different currencies that could eventually start spilling over into credit. And that's the risk that the Fed's going to have to figure out on their own because I have no advice for them. That's what we got going into this week. Thanks for watching. I'll see you again on Monday. Take care.